Now, another required statement for companies now is called the balance sheet. And we're going to go through the various components of the balance sheet. Then we're going to tell you how these two statements are kind of tied in together, how they interact together. Now, again, I'm showing you acronyms because this is common in textbooks and the like, and I want you to know the acronyms too, I guess. I don't particularly like acronyms, but here we go. Now, the left-hand side of the balance sheet. Now, these are the resources of the company, technically the financial resources of the company. These are things that, as the financial manager, you took owner money, what's called equity, and you went out and raised debt capital for the company, and you took all that money now and you bought assets with it. And these are the assets that you see on the left-hand side of the balance sheet. We have current assets. Current assets are simply assets that have a life of less than a year. Cash, marketable securities, accounts receivables, inventory, those are all common examples of current assets. You also have fixed assets. Now, fixed assets are simply assets that have lives of more than a year. Property, plant, equipment, those are all examples of a fixed asset. And if you add the current assets to the fixed assets, you have total assets. And again, the left-hand side of the balance sheet, this represents what you, the financial manager, have bought with the money of the shareholders and bought with the debt that you borrowed through the company. These are the financial resources of the company. And you want to buy assets that give you the greatest return. Okay? But these are the assets of the company. Now, companies are like you and I. Whatever we can't pay for with cash, we have to go out and borrow. If you and I went to buy a car, a $20,000 car, and we put $4,000 down, we'd have to go borrow the other $16,000. The $16,000 would be debt. The cash that companies pay for assets now is referred to as equity capital. So companies do the same thing you and I do. We either pay for it with cash, equity, or we have to go out and borrow the money, raise debt capital. What you see on the right-hand side of the balance sheet over here, this is the financial structure of the firm. This tells you how the company has paid for its assets. And the reason the left-hand side of the balance sheet has to equal the right-hand side of the balance sheet is because companies are just like you and I. If you want an asset, you have to pay for it. And everything on the right-hand side of the balance sheet up here, we're going to find out in just a moment, is either debt or equity. Debt that you borrow, that you have to pay back within a year, is referred to as current liabilities. This is short-term notes, accruals, accounts payable, things like that. But these are indeed debts that you owe within a year, and they're called current assets. The debts that you'll owe that have a life, if you will, of more than a year, those are called long-term debts. And indeed, long-term debt plus short-term debt, this is the debt of the company. The preferred stock financing, common stock financing, retained earnings, this is the equity of the company. And indeed, as I told you before, everything on the right-hand side of the balance sheet now is either debt or equity. Okay? Now let's talk about equity for a moment, and let's talk about this thing right here, retained earnings. Now, on a balance sheet, you might see retained earnings of $5 million, $10 million, whatever it is. That's not a pool of cash now. Cash is a current asset. So if it was cash, that's where it would be. As I told you before, there's only two things a company can do with its income. It's either going to pay it out in dividends or retain it in the firm. Any earnings left over after you pay your preferred stock dividends now, this is earnings that belong to you and me, the common stockholder. And this number right here, we're either going to pay it to ourselves in dividends, or we're going to retain it in the firm. Now, just to make my math easy, let's say there are 20 owners. You and I are one of 20 owners in the company. And the financial manager has generated earnings available to the shareholder of $20 million. Now, if you and I and all the other shareholders ordered the financial manager to do it, he would write each of us a check for $1 million. Not the worst idea we've ever had, but he'd write us a check for $1 million. Now, if he did, or if she did, that would be earnings that we would declare on our 1040 form. The first line on 1040 form, the tax form, income, interest, or dividends. This would be income to me and you. If we paid ourselves $1 million in dividends, we'd have to pay taxes on that. At the federal level, what's the marginal rate on $1 million? Something like 38%. South Carolina also has a income tax. We'd probably pay another 8% or so to that. So we'd have to write a check for $380,000 to the federal government and $80,000 to the state government. So we've already lost, what is that? About $460,000 of our $1 million just in taxes. Our income, our wealth isn't going up, it's going the other way here. If the financial manager came to us and said, look, instead of taking that $20 million in dividends, I'll pay you a dividend of $4 million. The other $16 million, we'll buy one of our competitors down the road here. We'll get their customers, we'll earn their cash flow, our cost of our raw materials will go down. All kinds of good things happen with that. And we estimate that if we do that, our rate of return on that would be about 17%. Now, paying ourselves dividends, we lost 46%. Keeping the money in the house now will make 17%. That's a big swing now. That's about, 64% swing here. Dividends as income, retaining earnings has more to do with wealth. And the normative objective function of a financial manager is to maximize shareholder wealth. Wealth and income are two different things. Okay? It's not that paying ourselves $1 million is the worst idea we ever had, but it doesn't really maximize our wealth in the long run. Now let's say that we had earnings available to the shareholder of $1 million, and we paid $200,000 in dividends. Well, whatever you don't pay in dividends, you're going to retain. And so if we pay $200,000 of that $1 million out, that means we'd retain $800,000. And this money right here goes into that account right there. So retained earnings now is kind of an accounting thing, and it tells us over the whole life of the company how much money we shareholders have not taken out in dividends, but rather reinvested in the company. If the retained earnings last year, if last year's retained earnings was $100 million, then after we add that $800,000 now, it's going to be $100,800,000. It's a cumulative number. The number on the balance sheet for retained earnings tells you how much the owners of the company have retained, have given back to the company of their income now. How much they've given back to the company cumulatively over the life of the company. Now this money that we retain, this $800,000 in this case, there's only two things you can do with retained earnings. You're either going to buy more assets or you're going to pay off your debt. Those are the two things you do with retained earnings. The balance sheet has to balance. So if this side goes up by $800,000 and this side goes up by $800,000, the balance sheet will balance. If this side retained earnings goes up by $800,000 and long-term debt goes down by $800,000, again, the balance sheet balances. That's retained earnings. And retained earnings shows you how much the owners of the company have retained, have kept in the company over the life of the company. They could have taken all that money out in dividends, but they didn't do that. They kept money, they reinvested money into the company. And they use that reinvested money now to buy more assets, or they pay off their debts. Retained earnings. And this is one of the connections between the income statement and the balance sheet. As I told you a moment ago, the left-hand side of the balance sheet, now this is our assets. These are the things that we've bought with the monies the shareholders give us, and we've bought with the money that with the debt capital that we went out and got. Now, what do you want the assets of a company to do? Well, the assets of a company have to generate goods or services that somebody wants to buy. If they don't do that now, you're going to go out of business. So the assets that you see on the left-hand side of the balance sheet, these are the financial resources of the company. The assets have to generate goods or services that somebody wants to buy. That is, they have to generate what? Sales, revenue. The more revenue, the more sales your assets create, the better off you're going to be. And if the revenue is greater than the expenses of the company, you're going to end up with more net income. And what do you do with net income? Well, you either pay it out in dividends or you retain it in the firm. And what do you do with retained earnings? Well, you retain it in the firm, you're either going to do what? Buy more assets or pay off your debt. And that's the cycle, the financial cycle that companies run through month to month, quarter to quarter, year to year. And that's what in the end now is going to determine whether or not the company is successful.